Welcome to SF Commercial Property Conversations with Bruce Bean, where Bay Area investments meet expert insights. Get ready to unlock the strategies of commercial real estate success.
So today we have Brian from BCRE, and Brian, I will allow you to pronounce your last name because I can't I can get close, but maybe not quite correct. But
No
Brian, it's
problem.
great to have you. I'd love to hear your history of how you got into real estate, where you grew up, and all the fun things that you've done to be where you are now.
Well, thanks, Bruce, for having me on my show. And the last name is Baniqued, right? So I'm Brian Baniqued. And let me see, let me go way back to 1991. So I actually got my real estate license in my senior year of high school. Um, Passed my real estate license exam in January of 91, and I turned 18 of March of 1991. And so I started selling and closing single family houses in my senior year before I graduated in June. And it was what I wanted was a job to be able to support my way through college, and so that was its original intention. So while I was going through to get a biology degree, I was selling real estate. Of course, it took a lot longer to get my 4-year degree, about 5.5 years. But by the time I finished getting the degree, I had been in real estate a good 6 years and was actually making a pretty good living at it. And so after like taking a small stint of a few months to check out what it's like to work in a laboratory doing recombinant DNA and realizing how boring it was, I decided, in January of 98, I got my broker's license, and then I started my own company. And in those first 7 years, I had made more of a name for myself in selling multifamily, right? So because I was selling houses in those first 7 years, I would always pre-qualify all my clients, and I'd ask them how much money they have. And my big pitch to them was, hey, instead of putting 20% down on a house, why don't you go buy this fourplex with 3% down since you don't have a house? Use FHA. And you could live in one unit for about 3 months. And then within 3 to 6 months, you can buy that house with 5 or 10% down. And now we've used anywhere from, 8% to 13% of your original 20%. And then for me, I sold them 2 transactions in 1 year in a 12-month period. And for them, when they moved out of that 4-unit building, um, they'd have a cash flow to supplement their mortgage on their house, right? And of course, and it was the same thing I did. So I would tell them, hey, listen, this is what I did. While the time I was a college student, the first property I bought was a fourplex. I lived in one unit, and I literally moved out in about 6 months because I was pretty much living rent free with my 3 tenants paying my fourth unit. And so I saved up all my commissions, bought my own house, and then used the cash flow from the fourth unit to supplement my mortgage, which really helped because when I'm closing deals, I'm just saving up all my transactional income. And then that allowed me to go out and buy 4 more buildings within a very short period of time of like a little under 2 years. And so it was that same model that I would educate my clients to. And so because I was selling a lot of fourplexes, multifamily stuff, I was advising them on, landlord laws, cap rates, GRM, and all, and cash on cash returns. And then I started becoming a 1031 exchange specialist. So like I would sell my clients 4-unit buildings, and then I would 2 or 3 years later, after a couple of rental increases, I would sell those 2 buildings and exchange them into like a 10-plex or a 15-plex. And this was the model that I just kept repeating. So as a broker, every couple of each of my clients, they're like an accounts receivable because I'm selling them a property, then 2 years later I'm reselling them and then trading them off into other things, and then I have new clients coming in buying their stuff. I did the same exact model for myself. So I sold my buildings and I exchanged into a 60 unit, a 38 unit, a 20 unit, an 86 unit, and then this office building that I'm talking to you from. And so again, I was using all my own examples, which was then increasing my knowledge and experience and exposure to multifamily office space and leasing for my own portfolio, right? As the model by which I would pitch my clients. And of course, that would turn each client into 2 or 3 transactions year after year after year, especially because of the nature of the 1031 exchange. A lot of my clients, just like me, were rolled into 60 unit, 80 unit, 100 unit, 200 unit buildings. And we're all just trying to go for this bigger unit count because it has this economies of scale. And that went on really well from like 1998 to around 2005. But which kind of segued into the development side of my real estate business, is that as I had these same clients whose portfolios I personally built up, and I'm building up my own net worth, I start delving into, looking at projects where I'm syndicating my clients' capital. I'm standing up for these construction loans, and I've got agents working for me, so we're locating sites that we can entitle and approve. And back between 2003 and 2007, I would, on one side, I would tell my agents, go out, sell real estate, do your cold calls, sell apartment buildings, sell houses. On the second side, hey, as a developer, this group that I've created, it's looking for developable land. So of course, that group that I created primarily consisting of my client base that I had sold multifamily to and exchanged into larger and larger units. They'd come in as limited partners, and then I raised about 15 million back in 2003, 2004, and we used that money to build a 64 unit, a 20 unit, a 24 unit, a 14 unit project where I was the general partner, and I would stand up for the loan. And then, of course, my agents who sold houses would sell off the individual units. I also had a financing arm. So I had 40 loan officers at the time, and they would originate the loans.
Oh, wow.
We were very vertically integrated. Um, and then, of course, I had a property management side, right? So all these transactions that we would sell, we would eventually, or most of the time, we would manage them for our clients. And then we would tell them, hey, hold on, don't get attached to it. We're going to sell it off in 2 to 3 years and exchange you into something bigger. So it was by the time I hit 2001, 2005, I had several vertically integrated companies all complementing each other. The sales side that, found apartment buildings, and represented buyers and buying apartment buildings and houses. Financing side that took care of 1 to 4 unit as well as construction financing and 5 units or more. A property management side that managed all those things. And then, of course, that fourth side was the development piece that I would just kind of take the bigger risks with in syndicating capital to go build projects. And of course, along that whole way, I'm learning all about contracts, financing, how deals are cut, and and the experience doesn't just keep me here in California, because you probably look back 2000 to 2004, and our cap rates in California were continuously coming down, our values are
Mhm.
going up. And
Mhm.
so for as investors, we're chasing these bigger cap rates. Of course, that takes us to like out of state, right? So I'm doing these types of multi-unit transactions for my clients, as well as owning them in states like Arkansas, Tennessee,
Mm.
Texas, Arizona, Maine, of all places. Like I had 150 units in Maine.
Whoa.
I was a Florida broker. So between that period of 2000 and 2007, it was a very lively office, right? Between all this
Wow.
traveling back and forth, buying apartments, representing apartment, clients for apartments, and had all these people within the office. So it was, and of course, then we hit the big Great Recession, and so that pushed a lot of us back a little bit. But I managed to hold on to just about everything and just keep the companies growing and gained a lot of expertise, from this
Ah,
period.
yeah.
People call them learning lessons, right? And of
Yeah.
course, that just kind of, gave a good foundation for a longevity, and then networking and all that kind of stuff. So all that throughout all that time from 1991 to 2025, and you mentioned you were in the business since before the 90s. You've just seen all these changes in our industry from how you would syndicate capital before to like now I'm seeing you can syndicate capital on a Reg C and D and openly advertise, and now there's a Reg A component. I've done the Reg B, Reg C, and Reg D, I'm delving into trying to do a Reg A type of syndication. But at the same time, we network the way we're doing now over LinkedIn, over Zoom, and we share our experiences over these podcasts as part of our advertising of who we are and what we do with the audiences that might be willing to look at them or listen to us versus what it was like back in the day when we're just putting out print ads that get people to contact us, and we're meeting face to face. So that's how I got into the business. That's how I got into investing. That's how I got into owning and managing different companies, and then got to this point, right? But of course, that foundation for that led, the ability to go out and take risks on other non-real estate related projects. So I, have my hands in a number of other things. Some of them did well. Some of them, I'm like, why did I do that? I could have spent my money on something else rather than losing it on some project that like some venture capital on some software that somebody told me was going to be the next big thing.
Yeah, right.
So
Next Google, here
yeah.
it is. Yeah. So just out of curiosity, going back to your first fourplex that you bought, how much did that cost? You remember?
I do. Yeah. No, that was $189,000
Oh,
for
wow.
my first fourplex, and I bought it with 3% down using FHA.
Oh,
And then I had my real estate commission coming back, and I asked for a 3% non-recurring closing cost credit, right? So, and this is what I would do for my clients who'd come, because I'd say, hey, well, we can get you a 3% non-recurring closing cost credit. Eventually, it was whatever your actual closing costs are. But I always run these calculations so I could show them, hey, you buy a fourplex, you're getting this. This is how little you can get into it with. Here's your cash flow. So when you annualize that, you have this really big cash on cash return, right? And so that was what I did. But that's what my first fourplex cost, and I still remember it, and it was fun. I held on to it for just 2.5 years until I just aggregated all these fourplexes that I bought, these 5 fourplexes, and then traded them into all those other larger multi-unit buildings.
so I'm curious, do you think that still works today? Are the numbers possible?
Not really.
Yeah,
Even back then, you'd see these numbers, slowly diminish and get less and less and less, right? The first time, when I first started buying fourplexes, it was right after the SNL scandal, right? So you have interest rates of 10.5. But even after the interest rates are that high and you pay your mortgage and everything, because the prices were so low, you'd see, based on your down payment and closing costs, you'd see like a 43% cash on cash return,
oh, wow.
right?
Whoa.
And of course, as part of the model of being able to trade these up to other people, right, is that, hey, well, if somebody likes a 43% cash on cash, they'll like a 33% and then a 23%. And so that allowed me to take the same building and sell it 5 or 6 times over, and over like a 6-year period to different people. And until I got to the last client where, like they're making a 13% cash on cash return, or, and
Right.
it's like, okay, you don't really want to go below that. But of course, now fast forward to the present, it's a lot harder to do that. FHA is not as viable, even though the loan limits have gone up. And then, of course, like the principal mortgage insurance on a FHA loan doesn't go away anymore like it did in the past. So, those different exits. It's not I still sell occasionally a fourplex with FHA to a client, but not so much anymore. It's not like I do it over and over again. Just the numbers just don't pencil. The prices have gone up so much, and
So where do you think is is there a unit number where the numbers start to actually work again? Is it 50 units? Is it 100 units? Or maybe that doesn't even work anymore.
it is really deal by deal, and it's right now at this exact time, a lot of the things that are going to cause a deal not to pencil are whatever the new insurance is going to be, right? Because depending on the age of the building, especially in California, that insurance cost might be 3 or 4 times what you were expecting. And it's hard now to go out and just pinpoint with accuracy what the annual insurance is going to be on a property when you're determining its operating expense, because it's a crapshoot. You got all these big insurance players leaving, so you're dealing with like out-of-state carriers, and that's a big piece, right? Because of course, the more expense, the less NOI, the lower the loan amount, the more down payment you need to come up with to make it work, right? So there's that aspect. And then there's the aspect of like, well, is it in a city where there's a heavy rent control? Is there a city where, what's in order to get insurance, do you have to spend a bunch of capital improvements to upgrade the electrical, the roof, and all these other factors? It's just one, situation after another. You remember, I'm doing multiple angles of the deal on a transactional side. So I'm looking at everything from a mortgage broker's eye as well. So I'm looking very closely at the operating expense, what the lender requires for vacancy, and if it hits the debt service coverage requirement. And then lenders trade things up, and they're like, well, we want to see it from but we don't just want a debt service requirement of 1.2 or 1.25. We want to see a debt yield of like 9 or 10, right? So, you gotta filter each deal through these different lenses, unless you just miraculously come across a buyer who's got all cash and doesn't, just bag loads of money, and they don't care about cap rates. It's all about prestige, but of course that's not the environment. And so you have a lot of owners right now that are writing off of these interest rates that we got when they were very low. And of
Right,
course, people see the interest rates are high. So you have these buyers who are coming in wanting to get the best deal, right? Because they're seeing more risk. They want a higher cap rate, which means a lower price. So it's just a lot more filters that you got to go through to get a deal through. And then once you get it in, it's like it's pulling teeth every single time on the financing side to get the thing to close. Like there's a couple I've recently closed commercial transactions that, they went over. We had to extend a couple times, like about almost like 4 weeks over the date, just because we had to retrade our insurance.
oh God.
The loan amount got cut a little bit, so the buyer has to come up with a little bit more, and you're just keeping the deal together. And then loan docs take longer. I mean, who knows, right? But those factors um, are present, whereas in the past it wasn't that stringent. But at the same time, in the past, we didn't have all the tools and the knowledge that we have today when we're really underwriting a deal. So it's a catch-22. It's some good stuff now and some things against you now.
So are you leaning at all towards looking at 1031 exchanges into triple net stuff?
I personally have not. No, I've just been kind of in a holding pattern with my own things, and just well, one, because um, I've been doing this development that's just really, been a very difficult ride. And to the extent where, because the loan amounts on that construction piece are getting cut, I've been putting on the syndicator hat again, and then raising capital for the deficit that the lender might give me to produce the thing, right? So because of that, I haven't been out there looking at triple net leases to go into, because, as you know, in commercial real estate, even those have their own hair, because sometimes you don't know if that building will be used for anything else. Some of the triple A operators, they're going out of business that you haven't seen, like, I think, is it CVS Pharmacy? That used to be
Yeah, oh
a
yeah,
highly
right,
rated triple net
right.
lease tenant, and they've gone out of business, so
Yeah,
it's
yeah. Walgreens, all of those,
yeah,
yeah, they're not nearly as desirable as they used to be.
yeah.
Yeah, that's a dicey area. So, all right. So, do you see any relief in the future?
I do. I'm still being optimistic. I mean, you watch the same news that I watch. I mean, we're in the same Bay Area. I mean, I've never seen the country this divided, and so much uncertainty in the air. I mean, one moment, like after 2020, I started trading stocks too, right? And
Oh,
I
okay.
kind of regret doing that, because it's been such a roller coaster high of highs and lows. It's very different from when you're real estate investing and you're so much more calm, especially if it's just multifamily that's stabilized. And so, to your question, do you see any relief in sight? I mean, just from my own experience over the last 34 years, all of these cycles come with a relief in sight at the end of it. I just can't put my finger on what the relief in sight will be in our particular case, because you've got, all these different factors going on right now with even with AI and some of the changes that have gone on in the real estate industry. But more importantly, like the volatility of insurance, the volatility of the interest rate, and then these prices that have to either come down in order to make certain deals pencil, right? So if the interest rates suddenly drop, which like I think Trump's been trying to push for, I'm sure that will play a factor in things, and that could signal a big light at the end of the tunnel. But whenever I'm talking to different lenders as a commercial mortgage with my commercial mortgage broker hat on, and I'm talking to my different reps, they're all in a similar boat where we'll get deals in contract and then they're just taking much longer to close because there's many more underwriting contingencies that are being thrown up because lenders are being more conservative because they're all sensing this, the uncertainty as to what the next light at the end of the tunnel will be.
So I'm curious, are you seeing more money out there available for syndication or less right now?
It's that's a great question. It sounds like from everything I hear, there's a lot of money on the sidelines,
Mhm.
Specifically for syndications. But when you actually get down to, what will move your needle to get you across the finish line? Well, we want to see an IRR of 25% over a 5-year exit. Of course, you're looking at that and you're like, well, okay, that's not as easily attainable. That's a lot easier said than done, right? So yeah, so it's it it, it sounds like there's a lot of capital on waiting to be deployed, but I also see a lot of holdback because they're waiting for that right moment or that blood in the streets and things like that.
Yeah, I mean, in the office market, there seems to be a fair amount of blood in the street, and people are selling at low prices. And
Yeah.
I'm not sure you really want to buy. We had a local office complex that sold for 75 million a few years ago, and recently resold for 25 million. But so those kind of deals are out there, but I'm not sure I'd advise anybody to take them. So anyway, there's a wild west world out there. So I'm curious, two factors. What CRM do you use, and what property management software do you use?
So great question. Right now, my partner and I have to run the management side. We're using Rentvine. Prior to that, we were using Appfolio, and prior to that, we were using Yardi.
Okay.
Um, and really, my partner Mark, who runs that, that more actively, he went through a number of different software solutions, and that was the one he decided on. And so far, this feel good, works well. What was your other question?
CRM.
Oh, so on for the syndicating side, I've just recently started with using within the last year and a half. It's called Go High Level, and it tracks a number of emails that go through in different marketing campaigns. But I'm also using some of the other CRMs that I've just always used, like Money RE, for the transactional side. But I'm also using some of the built-in CRMs with softwares like Crexy or BuildOut, right?
Oh,
Because those CRMs, like especially like the one on Crexy versus like LoopNet, it tracks the individual name and email and mobile number of people downloading offering memorandums, right? So you're getting a lot more metrics on an individual, especially if you have their email, because you can run their email and find out the whole history of the individual behind the email. And so it gives you a lot more surgical data for who to try to talk to, because that's got the greater likelihood of closing a transaction, right? And so the CRMs that I'll use are going to be specific to the task at hand, whether it's a CRM for syndicating capital and trying to raise capital from partners, or just the bread and butter transactional deal of being a commercial real estate broker.
do you even use CoStar LoopNet?
I do use CoStar and LoopNet, and quite frankly, I don't use as many of the tools on CoStar, as many as there are for the amount of money I'm paying for it. I actually find I use more of the tools on Corexy, which is a lot cheaper than LoopNet and CoStar put together. And I've had CoStar, man, since like 2003,
Yeah,
right?
right. Yeah.
And
Yeah.
it's super expensive, and it's like and there's like very specific things I'll use it for, and the rest of it I'll rely on like one of my brokers who knows it in and out, or I'll call a rep to get a specific bid out. But I don't find it as a really good source of like managing clients or as a CRM tool. It's more of like a research tool, right?
Right, right. Database research.
Yeah,
Yeah. All that side of the equation.
yeah.
Well, okay. This is a fascinating conversation. I think we could talk for another 2 days probably, but where can people get a hold of you?
Great question. Yeah, you can just go to my website, bcre.co. That's, Bravo Charlie Romeo Echo .co, no M. And there's a contact tool there that my one of my assistants will receive and get a hold of me on. Or ascendpartnersgroup.com, which is this another company, and that website has my Calendly on it. And it'll usually put you in touch with one of my assistants, and they'll schedule an appointment. But you could always go through the regular channels of LinkedIn. If you Google my name, you'll see all kinds of things pop up and different ways to reach me. And if I'm not directly responding to it myself, one of my people is, and then kind of putting it on my calendar. So I try to make myself available, so I'm not that hard to reach.
Okay, last plug for you. What's the name of the film that you developed?
The film is called Trees of Peace, and it was released on Netflix in 2022, June of 2022. It's still on there if you want to take a look at it. It's a genocide movie, and it's a period piece that is more of like an Oscar bait type of thing. So if that's your thing, watch it. It's not some action movie or anything like that, but it helped teach me a lot about the business side of movie production, which ironically was very similar to the development side of real estate. Um, yeah, but it's called Trees of Peace on Netflix. Like I was mentioning to you earlier, we won 13 awards in 2021 on the independent film circuit that later led to the deal we did with Netflix that got it onto the Netflix platform for distribution.
All right. Well, we're going to have a follow-up podcast and we'll just talk about films maybe.
Sounds like a plan, Bruce. Yeah.
All right. Well, let's stop for now and we'll talk again very soon. So
That's a wrap on today's journey through the SF commercial real estate scene. Ready to share your story? Visit sfcommercialconversations.com/guest. Your insights could lead the next conversation.